Welcome to the world of trading. This video will explain key components of CFDs and demonstrate how they are one of the most popular forms of modern trading. Remember, you can always read more on CFDs within the educational section of the XTB website. Let's get started. What is CFD trading? What does the term CFD mean? The term CFD stands for Contract for Difference. This is a contract between two parties, typically described as buyer and seller, on the movement of an asset price. There are several key features of CFDs that make them a unique product. CFDs are a derivatives product, and they are also leveraged, meaning you get the same market exposure for a relatively small initial deposit. One of the key features of CFDs is the ability to take a long or buy position when you assume prices will move up, or a short or sell position if you assume prices will move down. So you can profit from both rising and falling prices, making it a more flexible product than conventional forms of trading. But what exactly does derivatives mean? Derivative means that you don't actually own the underlying asset. You're simply speculating on whether the price will rise or fall. Let's take stock investing as an example. You'd like to purchase 100 shares of Apple, and its share price is $150, which means that the total investment would cost you $15,000. In exchange for this, you receive a stock certificate and legal documentation that certifies ownership of shares. In other words, you have something physical to hold in your hands until you decide to sell them, preferably for a profit. With CFDs, however, you don't own those Apple shares. You're simply speculating and potentially profiting from the same movements in share price. And you're able to manage your position online, which makes it much cheaper and quicker than traditional trading. If you want to know more, check out our next video or article. Thank you for watching.